Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, September the 18th. My name's Eric Wilkinson. Yes, you may recognize me from mainstream media as the Wolfman, but what I'm here to do is teach you guys how to implement option strategies. Anybody can teach you how to build an option strategy. I teach you how to implement those so that you increase your probabilities of success. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, let's get some economic data out of the way and then on to the markets. We've got Great Britain coming in with CPI, 1.7%. That's below the 1.8%, not really showing any inflation on the consumer side. And that's not unimaginable because we're starting to see a slowdown over there, and that's going to usually cause that to pull back a little bit, or at least we would like to see that pull back a little bit. We don't want to see inflation happen when the economy is going down, all right? So although that number doesn't look good as a headline number and CPI increasing, with their economy the way it is, I don't think it's necessarily a bad thing. And then we got PPI output, which is producer price index output. That's how they're going to pass it on to the consumer. One thing we're noting there is it came in at negative 0.1%, was expected to be a negative 0.4%. Last month's number was revised down, which is not a good thing. We want to see that number increase a little bit because then that shows that the economy is doing well. But the problem here is we're seeing the producers see the inputs rise, and they're not able to pass that on to the consumer, which is what you would normally expect to see in somewhat of a recessionary time there, right? They don't want to jab the consumer. They want to kind of just offload some of this stuff. And then we got the core CPI, Consumer Price Index, coming in at 1.5%, expected to be 1.8%, so not really a bad miss there, kind of, again, along those lines of expectations there. Now we move over here to the United States, and we got our building permits. And remember, I always talk about building permits. You can pull as many as you want, but it doesn't necessarily mean you are building on those permits. But that came in at 1.42 million and almost 1.5 million, expected to be 1.3 million, or 1,300,000, I suppose. And then we got the housing starts also ramped up, which is good because that means they're using those permits. That means their expectations of the economy here in the United States is relatively good, and that came in at 1,360,000, expected to be 1.25 million. Then we move on to crude oil inventories, and they rose despite the fact that we saw this bombing in Saudi Arabia. Well, that's not really going to affect those inventory numbers that we just got. That is a little bit further back than what has recently happened. That came in at 1.1 million barrel build, expected to be a drawdown of 2,100,000. All right, and then we have the FOMC today. They are expected to lower interest rates by 1/4 point. That is just to appease the market, I believe. We just saw there on the economic data, housing is not doing bad with the current interest rate structure, and lowering interest rates should ramp that up a little bit. That's going to be good for the builders, though. All right, let's move on to the markets. We've got crude oil coming off again by about $1, and we are breaking below those two support levels that we have seen hold as resistance on the way up, and we've talked about them. That $60 a barrel area doesn't line up with any Fibonacci, but that's a psychological level, and we peeled back and forth through that like it's butter. But you can see right here we've got the $59 a barrel right there, $59 barrel lining up with this Fibonacci, and then $58 a barrel right now acting as support. I don't expect it to really hold much weight there. I think, like I said, we're going to pull back down into the mid-50s. That's probably where it needs to go in order to get rid of some of these inventories. If we start seeing inventories rise and prices rise, that is a bizarre situation, right? We're going to continually see those that snowballing of building inventories if they get too high. But right now, holding up above that $58 a barrel mark. But I don't think it's going to hold a whole lot today, unless there is some kind of new information coming out right now. Saudi Arabia says they're going to be back online with their production numbers by in the next 10 days. So I don't expect that to be a major glut in oil production. All right, we've got gold moving higher. Right now, I think this is more of a flight to safety ahead of this FOMC meeting. It's really going to come down to their statement. We've got a lot of these Fed governors on the fence as to how much further they should lower interest rates, and I think that they are probably going to stop at this 2% after that 25 basis point cut today. So we'll be right at 2%. I think that's where we're going to hold off. I don't even think we need this 25 basis point cut, but if you got an adjustable rate mortgage, you are cheering like crazy. All right, now we've gotten back up into that 160 handle in the bonds. As you can see right here, we peeled back above that 160. It acted as a resistance with that 50. This is the 50-day simple moving average right here. As you can see, we've kind of got that to line up with the 100 or the 160 handle in the bonds. We're above that now, and that is because it's basically a 100% chance of a Fed 25 basis point cut. And we're going to see that probably happen today. But again, look for the statement. Watch to see what they're talking about with the economy. Don't really worry about the interest rates. It's going to be what is forward looking at this point. So bonds starting to make a move today. VIX is rising as we're seeing some of the equities peel off a little bit. I've expected us to get up there and test these all-time highs. Looks like we're rolling over a little bit here, finding support at that 9-day moving average, which is the little blue line here. This is the 9-day, and you can see it's kind of acting as support right in there. Again, I don't think that after this meeting we are going to have much of a fallout unless something really bizarre comes out of that statement. So at this point, I think we're going to get a little bit of a bounce. We might go down and test this value area high here, but again, I think that we are going to then bounce like I talked about yesterday. All right, Nasdaq is coming off by about 28 points, but again, it's basically an inside day. We'll see that in the breakdown of the E-mini S&Ps. Right now at exactly 3,000. I mean, I don't know if I've ever seen that, like just nail the number like that, but that was pretty cool. But down ticking again, right there in and around where we've talked about that 3,000 mark. The bulls are really going to want to defend that area. There's nothing lining up with it, but again, it's another psychological level, and I've talked about this since I started trading, that those psychological levels sometimes are more important than even the Fibonacci's. All right, we are seeing, it looks like we just peeled outside of an inside day, but for the most part, you can see the last several days has just been consolidating and people adjusting their portfolios, albeit very slightly throughout the day, getting ahead of this FOMC meeting. And, you know, it's prudent to do stuff like that, right? I mean, to get ahead of that, make sure your portfolios are in line. All right, now gold, like I said, is moving higher here. I'm looking to get out of my gold trade. I'm working on an order right now to get out of it. And if you guys remember, I have on those October, I'm short the 136 puts in there. So this move higher the last few days has been helping. I'm pretty close to 50% of my max profit on that. I sold those for 51 cents. I think it's trading around 27 right now. I'm working a 20-cent bid. So I'm going to hold on to that, probably get out of that before that meeting, as well as the USO trade. Oh my gosh. I mean, when do you ever get to talk about a trade like this where in one day you are basically getting out of this? I'm squeezing this a little bit more as well. Remember, I'm short those 13.5 calls in there. Yesterday's late day sell-off. I mean, I put those calls on when we started breaking down below this area here. We got a nice flush down. Volatility really coming out. Both directionalities, right? Being volatility, I expect to come out when I'm selling those calls, and the direction of the market as well. But this little doji right there, I don't want to mess around with a whole lot, and anything can happen over there in Iran. It doesn't mean that they can't come out with another drone strike today. They can't even trace where those drones are coming from at this point. It is really just assumed it is Iran. So I don't want to stick around with that I don't want to squeeze out that to the end of the day. I want to just take my 50% of max profit. So both of those trades I'm looking to get out of today, and most likely this crude oil one, as fast as that has gone down. I mean, I did only sell it for 30 plus cents, but 15 cents is 50% of max profit, and anything can happen in this market. So I'm not going to squeeze that out like I usually do with those 30-cent strikes. Sometimes I'll squeeze those out for a little bit more than 50% of max profit, maybe get out for 60% of max profit, which I'd get out for about 10 cents. So looking to get out of those today before the end of the trading session, and probably before even the FOMC. All right, that's all I got for you guys. Hope you guys check out my webinar on the put spread directional assumption. What we're doing is we are going through these webinars a little bit different than normal. We're not just talking about how to build this strategy. That's relatively easy. What we are doing is talking about how you implement this, when you implement it, how you implement it, where you implement it, okay? The strike location, the environment, all of those things and your directional assumption go together, and we spit out a strategy, all right? So check that out, and if you can't take that, take it easy.